bonds are woefully mispriced, yields need to be much higher, prices need to be much lower, stocks are overpriced, their multiples are too high. The US dollar is dramatically overpriced because it's going to lose a tremendous amount of its purchasing power over time, and therefore it should have a much lower exchange rate than the one it has right now. It also means that gold and silver prices are much too low. Well, now that the Fed has now been confronted with the data, and I always assumed that once the GDP numbers came out for the second quarter, that they would have to admit that we were in recession. In fact, they shrugged off the negative GDP in the first quarter and still pretended that we had a booming economy. But when we followed that up with the second quarter of negative GDP growth, I initially thought, well, okay, they're just going to have to admit there's a recession. But no, they haven't admitted it. They're still denying that there's a recession. And how are they doing that? Well, they're redefining what a recession means. Because for my entire career, we've defined recession, and so has everybody in government, everybody at the Fed. It's always been defined as 2 consecutive quarters of negative GDP growth. Well, we meet that definition because we just had that. In fact, the declines in GDP are likely bigger than what the government admits to because they are understating inflation in their deflator. So the economy is actually weaker than the numbers indicate. Yet despite those negative numbers, the Biden administration and the Fed claim that we are not in recession, that the recession doesn't actually mean 2 consecutive quarters. It means a broad-based decline in the economy, which is kind of subjective because somebody has to determine whether the decline is broad-based enough. Although from all the evidence that I've seen, it's very broad-based right now. I mean, housing's in recession, autos are in recession, retail, advertising, all sorts of unrelated parts of the economy are contracting, yet somehow that doesn't constitute a broad-based decline. So despite this evidence, the government continues to pretend that the economy is not in recession, and part of that is so the Fed can continue to talk tough about raising interest rates because it's ignoring the damage that those rate hikes have already done and will continue to do. Because as the Fed continues to raise interest rates, GDP growth in Q3 and probably in Q4 will also be negative. And so we could have 3 or 4 or more consecutive quarters of GDP growth. Eventually, the Fed has to acknowledge recession. In fact, as the Fed raises interest rates to fight inflation, it undermines the economy because of all the debt service. It also helps push consumer prices higher because higher interest rates are just another cost that businesses have to pass on to their customers, and it's another cost that individuals bear who have debt. We have record credit card debt, student loans, auto loans, mortgage debt. All of these payments are influenced by higher interest rates. Now, I'm not saying the Fed is wrong to raise interest rates. The Fed needs to raise interest rates. In fact, it's the market that needs to raise interest rates. The Fed needs to get out of the way. That's what Paul Volcker did. He didn't put interest rates at 20%. He got out of the way. And the markets put interest rates at 20%, even though inflation was no higher than 13.5%. And of course, if we still measured inflation today using the same CPI that we used to measure it in 1981, we would be much higher than 13.5%. And the markets would obviously put interest rates maybe even higher than 20% if they were allowed to function. But they're not being allowed to function for the obvious reason that everything would collapse. Back in 1980, we could afford to pay 20% on our debt. We only had about $1 trillion in the national debt, not 31 trillion like we have now. But more importantly, most of that debt was locked in with 10 to 30-year treasuries. So higher interest rates only affected the immediate borrowing needs of the US government. Now, with about a third of the debt maturing every year, we have such a short maturity and we have such enormous current deficits that any big spike up in interest rates immediately bankrupts the US government. There is no feasible way of making those payments. They can't raise taxes high enough to do it. And of course, if interest rates went that high, we would be in a massive recession. And so tax revenues would collapse while government spending exploded. So there is no viable way to allow interest rates to rise to a market clearing level, but that is still the right thing to do. The Fed needs to fight inflation, and it can't do that without pricking the bubble in the economy that was created by inflation. So if you take all the inflation away, then the bubble collapses. We're gonna have a massive economic collapse. We're gonna have a worse financial crisis than 2008. Stock prices will crash. Real estate prices will crash. Bond prices will crash. The US government will be forced to cut government spending dramatically, even on entitlements like Social Security and Medicare. And it will probably be forced to default on the national debt. Now, that doesn't mean that people who hold treasuries get nothing, but they're not going to get repaid in full. They're going to have to take a haircut. The debt is going to have to be restructured so that the principal is reduced to a level that the US government could actually afford. Now, all of this stuff would be political dynamite. I mean, it would probably be suicide for whatever the party is in power that was forced to acknowledge all this, which is why it is not going to happen. The Fed does not have the political will to force all this to happen. So everything it's saying about its commitment to fight inflation is a bluff. The Fed will give up the inflation fight as soon as it's too politically dangerous to continue it, as soon as the collateral damage is great enough that the Fed has to pivot and then focus on the economy, on employment, on financial markets, because that is what the Fed has always done, and that is what the Fed is going to do. The question is, will the markets start to price in this pivot before it happens, or will they wait for it to actually happen? And what the markets still don't understand is what this means. Because while there are enough investors who understand that the economy is either in recession or headed to recession, those same investors also believe that the recession will do the Fed's work, that inflation will go away as a result of the recession, that as the labor market weakens and unemployment rises, that will also reduce inflation. That is wrong. Inflation is not caused by economic growth. It's not caused by low unemployment. It's caused by the deficits and Fed money printing. And money printing and the deficits are going to go up in the next recession, not down. Now, in the past, that monetization manifested itself in asset prices. That ship has sailed. We're beyond that now. We've gotten to the point where inflation is going directly into consumer prices, and that is going to continue. Oh, and by the way, the idea that the US has a strong labor market is farcical. Just because we have an official low rate of unemployment doesn't mean the labor market is strong. In fact, the 3.5% unemployment rate is 6.7% if you include people that are working part-time involuntarily and discouraged workers. That used to be the actual unemployment number until they decided to change it. But of course, if you include the long-term unemployed, which the U6 excludes, you've actually got an unemployment rate above 10%. That's not a strong economy. You also have labor force participation, the lowest it's been this year at 62.1, and well below where it was before the pandemic started. That is not a strong labor market. Real wages are collapsing. Yes, workers are getting wages, but those wages pale in comparison to the increase in the cost of living. So when you have a labor market where workers are forced to accept pay cuts, that's not a strong labor market. In a strong labor market, workers are able to demand raises, and their employers have no choice but to pay them. And a raise means that your paycheck goes up more than the cost of living, not less. And in fact, people's paychecks have been so significantly reduced by inflation that one paycheck is not enough. You now have a record number of people who hold down 2 full-time jobs. And the number of people with multiple part-time jobs is at a post-pandemic high. In fact, almost all of the jobs, in fact, I think all of the net new jobs over the last 2 months were attributable to people who already had jobs getting second and third jobs, meaning the vast majority of those jobs were part-time jobs. So in a strong labor market, you don't need 3 jobs. 1 job is enough. But in a weak labor market where one paycheck doesn't cut it, that's when you see a big surge in moonlighting, and that's what we have. But the big issue is that, yes, investors are correct who are betting on recession and that the Fed will pivot in the face of recession. But they are wrong to assume that that pivot will represent some type of victory over inflation, either because the Fed hiked enough or because the economy went into recession and that solved the problem. No, this is not going to be the type of pivot that we had back in 1982 that was very positive for stock market, for the dollar, for the bond market, a pivot that was negative for gold, because when Volcker pivoted, he pivoted in success, in victory in his war on inflation. When the Powell Fed pivots, it will be in defeat. Inflation will have won. Inflation is never going back to sub 2%. In fact, it's not even going back to 2%. I mean, maybe not never, but certainly in the foreseeable future for the remainder of this decade and probably a lot longer, inflation is going to be considerably above 2%. We are living in a very different world. In fact, the world that we lived in with sub 2% inflation, that was the exception. This is the rule. That was some kind of fantasy. We are now back in reality, and the reality is high inflation, well above 2% as far as the eye can see. And that means that bonds are woefully mispriced, yields need to be much higher, prices need to be much lower, stocks are overpriced, their multiples are too high. The US dollar is dramatically overpriced because it's going to lose a tremendous amount of its purchasing power over time, and therefore it should have a much lower exchange rate than the one it has right now. It also means that gold and silver prices are much too low, because right now gold is priced for a world where there is no inflation, where inflation has been vanquished by a tough Federal Reserve that is committed to ridding the economy of inflation. When the markets realize that that's not the case, that the Fed is going to choose inflation as the lesser evil, because that's the choice. Do we have a massive economic collapse, financial crisis, depression, waves of defaults and bankruptcies, or do we tolerate higher inflation? The Fed already made that deal with the devil, and it's going to keep its commitments. We're going to have higher inflation.